Good day, fellow investors. We continue with our weekend 10 stock analysis that you have suggested. And Nhat said here that stable cash flows, margins, big value is if we look at Kohls. Let's see what I think about it, because you always want my opinion, so here it goes. If you make suggestions, I always love them, but please do them in a valuable fashion for everyone else. Write the name, the description, the risk, focus on the risk and the reward, and what will be the catalyst that will make us money in the future. On Kohls, let's start with the stock price, and yes, it looks extremely cheap. This is 75% down from the peak. It was destroyed here, rebounded, peaked, and of course everyone wants to see a nice double here and another rebound. If we look at the numbers, the market cap is 3 billion, the P ratio is just 5, so extremely cheap, and the dividend yield is 7.55%. Of course, this is not stable, so that's what we have to look at. Let's take first a look at the business. And when I look at the Q2 summary, I see a lot of issue. Weakening macro environment, high inflation, and dampened consumer spending are having a broad implications of retail. So when a manager starts talking how bad things are, then you know that things are bad. Comparable sales decreased 7.7%. and net sales decreased 8%, and that is huge because in retail you have extremely thin margins, and when your gross margin decreases 3 percentage points or 290 basis points, then you know you are in big trouble. Other expenses due to inflation increase, operating margins goes down, and yes, they are still having some earnings, but unlikely to continue. And then even inventory boomed 48%, which means that you need more cash flow, you need more working capital, you need more cash. And that also trickles down in the metrics, and you can see here how the earnings per share from booming a year ago went to busting, so that's a 60-70% decline. They have some long-term debt, 1.7 billion, a lot of inventories, and if you don't move these inventories, then it can get ugly, and the cash flows are negative because of the inventory, of course. Free cash flows 1 billion down, and that's a big hit. Of course, there is an outlook. They want to bank on Sephora, plus on the negative cash flows. They are investing there a lot of money. They are paying a dividend because everything is about the dividend. And then they also entered an accelerated share repurchase program. They give the money to a bank to do these repurchases. And with retail, okay, the most trusted retailer of choice, casual lifestyle, everything great. The management is doing a lot of things to try to bring it back to growth and push that stock price higher, leading with loyalty and value, differentiate omni-channel, and all these big words that you have been hearing in the sector for the last decade or something. But then again, we just go to Charlie. Being in the department store business would be very unpleasant, says Charlie Munger. What's the problem? Well, the first thing is you see it in the stock price. Of course, that boomed in the 1990s, 1890s, early 2000s. Then the internet came and it became ugly, ugly. Many went bust. Kohl is still surviving, but the truth is that it is an extremely hard sector. There is no differentiation, there is no moat, the competition is ruthless, margins are thin, which makes it a risky, highly volatile environment. And with Kohl making $1 per quarter, that's 3-4 per year, it gets to an average P ratio of 10. Google has a P ratio of 18. Now, where do I want to put my money in? Kohl's department store, something that can be ugly, yes, can rebound, but it's more likely to remain a value trap, and I simply don't like the risk and reward, so it is not a contender for my YouTube portfolio because, as we discussed with eBay, as we discussed with Kohl, there is not that positive line of future that will give value no matter what. Worst case scenario, I want to be okay when it comes to investing. And worst case scenario here, I don't know whether I will be okay. So if I start following it now, then I see a path of just ugliness ahead, a potential one. It can also rebound, but will it? Too much risk for the reward. The risk is zero. The rebound is a 2x with some dividends or buybacks, and it's simply not a game that I want to play. I want better. I hope you want better. Let's go to the next stock in a few hours. I'll see you in the next video.